That's where I think the mistake comes, is like understanding different environments when it's volatile. Most new retail traders think that that equals opportunity, but it's not necessarily the case. I kind of want you to lead the conversation today, Jared. You got the boomer, the Gen X guy. You got Trader Kane. Kane, are you a millennial or Gen Z?
Actually, I might be a millennial.
Yeah.
I don't know.
It's going to depend on how I think Kane answers some of these questions, right? You got the Gen X guy and you're the other Gen X guy. So maybe you dictate traffic between he and I, and FOMO for FOMC, or really kind of anywhere you want to take it, I'm good with.
The ability to hold trades longer is very, very different when you are an established trader who's got a proven edge and, is capable of yielding money. I mean, I'm not saying that it's always easy. When you're trying to break through, I think sometimes a lot of traders have this kind of internal governor that they think that the risk is greater emotionally. The risk is greater to have a profitable trade reverse and stop you out than it is to actually hold it to its intended target and to deal with the internal stress and turmoil of watching it dance around, because it can be draining just having to sit there watching it. But you've got to really understand that the risk is greater to your long-term ability to be successful by chopping out a good chunk of the profitability of each of these trades. So the ability to kind of withstand that internal tension, I think, is a very important skill for traders to develop. It's one that, I think many athletes develop over time, right? As they're climbing the ranks from, let's say, the juniors to playing high school to college to lower level professional leagues, right? And then when it comes time to sink the winning pot, make the winning basket in a tournament, it's a lot easier because they have so much of a track record established in dealing with those very, very intense moments. But traders oftentimes kind of come off the street from a normal job where stress is very different. It's not about trying to break through and live out dreams, make money that can transform your life. Your normal day-to-day stress is whether or not you're going to be able to get to work on time and deal with the demands of that job. So there is a time consideration here of giving yourself the opportunity to build the hardiness and the strength, the potency mentally to be able to kind of withstand those intraday tumultuous moments of actually just holding. And with a lot of my clients, I have them actually pull out their phone, open up that stopwatch app, and as soon as they start to feel like they want to close the trade, you just click that button and see how long you can go for. Trade over trade, day over day. See if you can condition yourself to go longer and longer. I mean, much like athletes with physical conditioning, physical strength building, it's just one kind of trick that I've kind of come up with that can kind of help to do that. It sort of changes the game a little bit. It's not about making money in this trade. It's can you actually make progress? Because it is a requirement for you to be successful long-term to be able to hold trades to their intended target. So I'm just kind of curious from both of you what that might have looked like in the development of that kind of hardiness and that strength and withstanding the ticks moving up and down a lot while you're waiting for that trade to close.
I think for me, right, I've seen the amount of times I've closed trades just before I get stopped out to save myself a few bucks, and then I end up being right. And then I use the same logic in my TPs being reversed, right? Like obviously I'm not closing early before it reverses. It's like I want to make sure that I have a model, I have a predetermined exit on both sides and a predetermined point at break even, and I let the probabilities play out. I know I can't control it, but I only know that because I've had to succumb to it over the years. And I will admit this, I have a big ego problem in my life, or at least I did, right? I really cared about being right more than I cared about the outcome. I had to really reflect on that in my personal life before I could reflect on that in my trading life. And actually, sometimes I'm like, this trade's going to play out. And then I can make every excuse as to why I didn't. But the truth is that it was just a trade that didn't play out. It was just one of those.
Were there times where you would close a trade prematurely because in that moment you sort of spontaneously thought that it was going to reverse? And so that was another way of being right, even though it kind of deviated from the initial plan.
Yeah. And, if my model forms against me, then it's my model forming against me. It's completely different, right? But if I'm just like, oh, this needs to hold and it doesn't, and it's 100 points away from my entry, and then I close it, and then we fall through the face of the earth, and we go to my TP, then I get annoyed at myself. I get frustrated. Not really because I made money and I'm happy on the day. It's because I cheated my future self out of money, right? Like I said, my job is to find a model, find an edge, get confidence in that model and edge over a period of time, and then let those probabilities play out in the future. I've let go of the attachment to being right. I like being right because it obviously monetary value means that I'm making money, paying my bills, living my life. But if I'm right today or wrong tomorrow or wrong today and right tomorrow, who cares in 3 months? Because over a period, I'm right X amount of time, and I had to really know that this is a long-term game. I've had short success, long success, short failures, long failures. We've done it all right. But it's actually knowing that if this is going to play out, if I'm going to use a data pool of 5 years to back test my model and then judging it on a week of losers, then I'm an idiot. the sample size is the same. So it's like, I'm going to use the data pool of a longer period of time to then later on only judge it on a week of losers or a bad month or a bad quarter or whatever. And then I go back and look at my model, and January every year just is awful for my model. Where in January we're having a bad time. This is just the data pool that we back tested, become confident in it. So it's like, if I'm going to darn the sword of the data, darn the sword of the data and leave the rest of it on the table, you know?
Yeah.
So,
and Anthony, for you, I mean, obviously you got your start in the pits. Hard to imagine too many more stressful environments to deal with. How much do you think that kind of prepared you for being able to withstand the internal turmoil that is required to hold trades to their intended target?
Well, as you know, the pit was super short term. Nobody was almost holding trades for more than seconds. I mean, some guys did hold them for a little bit longer, but not many. I just want to comment on one real quick thing on Kane while it's at the top of my mind. And it's great to see Kane talk about how he thinks more long-term now at 31 years old, because at 30 years old, I did not think that way. And I was continually thinking short-term, and it was a continued issue for me. But when I started to think long-term, my short-term success got so much better. And I think that's a big psychological shift for younger guys and girls that are in this business to start thinking long-term, because it gives them the ability to slow things down. Like he said, it's just January. But when you're younger and you feel like you have to make money, the only thing you think about is today. So I just wanted to say something about that because I thought that was perfect. But getting back to the pit, for me, I think it was really difficult because pit traders were so super short term. And then when I went on the screen at a very early stage in the late 90s when the E-mini was just starting, I was trying to do what they were doing in there, and it was just extremely difficult. And so one of the ways that I learned how to remove the attachment, one of the things was I constantly tested myself. So like when I got to areas I really liked, I almost was testing myself incrementally with size and then just rotating out of that size really fast. So like I would work my way up to 5 minis, 10 minis, 20 minis, 50 minis, 75 minis, 80, 100, every time my goal was to scratch them. But what I did was I would keep like 2 or 3, and then I would be like, it would almost be like this increase intense moment of like, could I handle it with that position on? I'd be like, cover them. And then next thing you know, when I had 2 or 3 on, I was able to like slow it down and hold them. So I started to develop a style where I got really aggressive at price areas that I liked. First of all, if they went against me, I'd burn out of them right away, and then I'd try to get back in. It's a different time. Markets weren't as fast. But that's how I built it up, was just consistently testing myself. And so as I got into bigger positions really quickly and I peeled them off, it was easier for me to sit in smaller positions and hold them. And so I felt like I had to train myself, and I felt like I go from a high level of intensity to call them back. I'd be like, oh, it's only a 3 lot. Now I can hold it. And I would let it play out. And that's how I started to get that emotional disconnect from the money, was able to hold positions. And it was funny, I would make more on 3 lots a lot of times, or 5 lots, than I would on 50 lots. Because the 50 lot, I'd cover 47 of them for a quarter tick or have 50 cents or a quarter tick loss, and I'd hold 3 and I'd make $2,000. So that's what I did.
I mean, it's a brilliant way of conditioning yourself. I think the principle holds. I think for a lot of traders who are struggling to be able to do that, think first about conditioning. If that doesn't work and you're getting tripped up and being unable to hold, you got to kind of examine a little bit more of the kind of fear, the anxiety, the overthinking that's present in there. And some of that might just come from a slight lack of conviction in your strategy. I mean, both the guys here have developed their systems over a long period of time. They have a bedrock of knowledge that they are relying on. If you're relatively new in the game, and I say that being like south of 2 years, you're still developing. You're a bit of a toddler kind of bumbling around here. I'm not saying that you can't be successful. I'm not saying you can't make money, but I am saying that when you have a longer track record, that confidence and conviction to hold is a heck of a lot easier. Not to mention, there are kind of less holds. I've got plenty of clients who struggle with being able to hold trades as well as FOMO, sometimes because there are just slight weaknesses in their strategy. If their entries are just a little bit off, then holding to your target gets a little bit more difficult. So examine the conditioning aspect, examine a bit of your strategy, work to build a bedrock of confidence that is going to happen over time. But you want it to be coming from the right place, which Kane, you mentioned the gambling earlier. Obviously, may do it occasionally as a hobby, but if you're here as a serious enterprise, I mean, gambling is the antithesis of what you're trying to do here. You need to become the house. And so if you're kind of gambling your way to confidence, which is what a lot of traders end up doing, both in protecting and closing trades prematurely, and or on an FOMC day, trying to run up a big number here, you're trying to gain confidence in the wrong way. It's not reliable. It's not what you ultimately want to have as you kind of further go up the ladder here of success. Because at some point, chickens are going to come to roost and the house of cards is going to fall apart here a little bit. So I guess when we kind of maybe pivot to a little bit of the FOMC kind of day and the, we'll say, seduction for a lot of traders who ought not to be, I think of hindsight bias as being a big problem. There have been many other FOMC days where traders have maybe come in with an idea of what could have happened, see it play out, and then get really pissed off. And then the next time you kind of have that belief, it's easy for the hindsight bias to start to kind of turn into foresight, but that foresight is a bit kind of wishy or hopeful. How do you see traders being a bit kind of wishful or hopeful on days like today?
They think that volatility in the market is always good. And there's a difference between good volatility and, I would consider erratic volatility. When it's volatile like it was last week, or, talking about Kane was talking about from 22K down to 19K, it's like he had reasons why he believed it and we got volatile. So it's like we take advantage of those times. You come in today and you miss one thing that Powell says in a presser and it's a ripper the other way. And you have no way to react to it in real time because the machines are just too fast. And so to me, it's almost all luck, because in a situation where we are in today's markets, news travels at the speed of sound, right? And so there's no way he or I or anyone can just go, oh yeah, we're in a key level now, I'm going to get in. So really, you're not building any skill. You're just going in there and you're hoping for the best, right? And so that's where I think the mistake comes, is like understanding different environments when it's volatile. Most new retail traders think that equals opportunity, but it's not necessarily the case. I mean, that's the first thing that comes to my mind.
I purely just look at it as gambling, right? Like I just share the same sort of thing, like playing any sort of news. It's like if you truly believe that, even I've seen it sometimes where FOMC prints that NQ should rally and it just dumps because he said the wrong thing at the presser, right? And it is just literally that. And then the next day it corrects or whatever. But I've just know over periods of time, sure, it feels great when you're in a trade. And I spoke about it earlier, there have been times where I'm like, oh, wow, it's 10:01. Okay, look at my trade, and it just absolutely crushed to my TP. But it's like I've also done it the other way. It's crushed to my stop loss and slipped me out 10 points, So I don't want to be positioned in the market. It just absolutely skews my probabilities and my edge. And if it does that, then I'm really cheating on my system. And I'm just gambling money, which I just can't do.
What Kane said is so true. Is like you could even know what the news is going to be today, and you could still be wrong about what happens. Yeah, that's the truth of it. Powell could say, we're doing nothing. And then he goes, good afternoon. And it just goes, and it goes lower. And you're like, dude, like what happened?
Yeah, he wears his green tie just the first time ever. And just rallies 1,000.
Right. I mean, the Bernanke briefcase and all the different things. Always got it in his left hand. We're going higher.
Yeah, exactly, man.
You can hope for certain things that are beyond your control. Not that big a deal. You hoping for outcomes here, to me, that's a surefire way to know that you are actually gambling. And I'd say that some of the viewers here don't necessarily know that. So if you have thoughts in your head about hoping or wishing for outcomes, make the link that that's you trying to gamble here. And to become a skilled, profitable trader is the antithesis of that. You're trying to become the house. The house has no hope. The house's only job is to keep getting butts in the chair to get their customers there, because they know it's a probabilities game over the long term, which you both have talked a lot about. Yeah, I think another big issue on days like today, I think one that really does drive a lot of FOMO, is revenge trading. Sometimes FOMO is not really the fear of missing out. Sometimes FOMO is actually the mind's way of kind of manipulating you into seeking revenge for prior losses, and maybe not even necessarily recent ones. It could be a longer track record where you're actually in a bit of a hole. You've lost money in your own accounts, you've lost money in some demo accounts or some combines, and you're looking for today to kind of make up for those past losses. Have either of you experienced that both personally, where you can kind of feel the increasing itchiness of some of those past losses kind of compelling you, and seeing the way that your mind can kind of manipulate present market data to retrofit into an idea that seems justified in the moment, but in retrospect actually was quite dumb?
Yeah. 2 weeks ago, my copy trader absolutely tore one of my accounts to bits. I lost like 10 grand in no time, right? Didn't copy any of my stops, nothing, and just opened it up, boom, minus 10K. 3 days later, I approached the chart like Monday, and it's just like, got a gut feel, we go to Asia High. I'll load that account up. Asia High is 10K. I'm like, why am I sizing this way? Oh, because it makes up for the loss. And the loss was out of my control, right? But I'd sized my trade based on one, gut feel. The model wasn't there. Like, it was kind of trending. Sure, played out in my favor. Great. But the sizing was completely to reattribute the loss that was out of my control to some degree, right? And I'm a big advocate of journaling my losers. Don't typically journal my winners because it just skews my data, and I like to just keep my losers all compact. And I journaled that one as a loss despite winning, because I did fully emotional trade. And there was just like, I just wanted to recoup the loss of that specific account, because I should have lost a couple of $100, maybe a K. Instead, I'd lost 10. You know what I mean? And it was just a massive loss that I didn't want to lose. So how do I combat that? Typically, if I feel like I'm over trading, I'm trading too much, I will just leave my laptop, leave my studio, go downstairs and go out. And sure, I can go on TradingView on my phone, but I normally just put myself in a coffee shop with someone that it's rude to sit on my phone, put myself in a situation where I can't do it. Because I do have those tendencies to pick it up and be like, oh, then my ego is kicking in, So I just don't do it. I just put myself in situations where I can't do it.
I absolutely love the fact that you treated that as a loss.
No.
Trading is such a hard game, and it's so hard because the false feedback you get in the short term. But when you know that you've made mistakes, it's a sort of irrelevant as to what happens in the outcome of that trade because you've got to be better at it. And yeah, I think the tactics you've described here are quite sound. Dowie, as we come to you here, I'm really curious if you can kind of precisely describe the mental manipulations that occur. I mean, Kane talked about how it was from a sizing standpoint, but even just perception of price action or the way that you interpret certain indicators that you're using. How have you noticed over time, and maybe not recently, but how your mind can get manipulated by past losses?
I think as traders, we think we see too many edges, and we don't have that many. And so where I make a mistake over and over again is very similar to what Kane said, is you get into a situation where intuition or gut or looking at a scenario going, yeah, we're going to go there. That's where I get into the most trouble. Right? For me is thinking I see too many edges when there really isn't that many out there. I mean, that's the mistake I've made over and over in my career. I always think I'm smarter than I am, even though I don't think I'm that smart, right? But that's just what happens for me, is that it's amazing to me how much a rhythm matters. When I'm making good decision making, then it's contagious. When I start making bad decision making, it's contagious. Or if I make a mistake, how then the next thing I do is really the most important decision for me, right? And so go back to what happened with Kane. He did nothing or something happened to him the next time. It's like that next move is really the one that impacts you even more than the initial one, because the initial one's like a shock and it's like, okay, you almost can get past it, but it subconsciously lingers. And the next thing you know, you get in a situation where boom, you're doing something else that's led from that. And I think that's why FOMC, it's such a popular day for traders, and why we're talking about FOMO is because people, I think dependent on where you are, a couple things happen. As one is if you're struggling, you feel like it's an opportunity to get it all back. So that's number one. So you think that you see something that's potentially there. The other part of it is you've been doing well. You feel like you've got a few bullets in the chamber and you come in and you just get blasted. I mean, so it's like for me, I look back at my career, I've never had my best days on FOMC, but I've had a lot of my worst ones on it. And so therefore, I've now trained to know that this is just not the great day for me, because at the end of the day, I've never taken good decision making and continued through in an FOMC, and goes back to what, there's no skill being developed here. You're not going to go back and look at your model and say, this was a day that this really worked well. It's a luck day. And so that's kind of where I am with that.
Yeah, I think one thing for viewers to kind of maybe take away here is both have kind of described patterning that exists internally for yourselves, right? We're always kind of looking at market-based data to identify the edges, but my work centers on being able to generate the same kind of internal data to be able to identify where your edges are and where they're not. And so one of the tools that I use is just called a data collection worksheet, where you're actually writing down in real time on a piece of paper, in a Word doc, the thoughts that you're having when your emotions are starting to kind of rise, or the perceptions of the market, perceptions of price action, perception of positions that are open, that are kind of deviating from an optimal, right? Rise in emotion, maybe change in your posture, change in your actions or your behaviors. All of that internal data can be used to be able to differentiate those times when you are probabilistically going to make a dumb decision versus probabilistically, actually, there is real intuition here. There's distinct markers that exist that tell you when that feel or that gut is more likely to be accurate than not. And for a lot of my clients, when their intuition is correct, there's far less internal noise and chatter. There's no tension. There's a sense of just like something making sense, as if the market just kind of handed them this idea. Something comes to them versus the very kind of strong mental activity and the emotions and the stress that's often kind of bringing you into the market. You're bringing that bias in the market. So very, very simple task to do. One that I strongly advise all you watching to do. Start keeping track of this data in real time and be able to firmly distinguish those internal markers. Both of the excellent traders here have that, but they've developed it over a long period of time. You can accelerate that process by just doing it a bit more consciously. So I would say that that task is a way to help bring about a bit more mental clarity. Kane, you kind of alluded to this prior to the segment here about getting out of paying attention to the price action within this trade. There's nothing left for you to see here. You're happy to kind of get along and answer questions in the chat because there's nothing more for you to do. So creating that mental clarity is a very, very important thing for traders to do. I think that a lot of times there's this sense that you just kind of have to be glued in at all times, but you're constantly absorbing information. And much like a sponge that becomes oversaturated, your mind becomes cloudy and then you become vulnerable to making mistakes. So what are some other ways that both of you kind of help to generate that mental clarity, both from an intraday standpoint and maybe in your routines outside of trading?
I want to go to Kane here, but we've only got about 30 seconds left.
I just limit my trading hours, and outside of trading hours, I just try not to look at the charts. If I need to look at the charts, it's normally to answer a question or for one of my students, one of my mentees, something like that. But it's always on past data, or I just use the replay tool so I can't immediately stop data printing, so that I can't be interested in how price is printing. Because there have been times when 4 or 5 years ago where I'd be teaching someone and then I'd be like picking up my phone, trading with my phone, have a laptop next to me to trade it. It's just like I'm doing another job here and it's just too much. So I would limit the amount of live data that I'm reading, which is literally, as I said to you before my segment, as soon as the line break even, I would have just got up and went downstairs and gone out and watered the grass, like something like that. I don't want to look at it. I won't look at it. Lock trading view on my phone. I'm going to have to really go out of my way to look at it at that point. So yeah.
We'll end it there. I couldn't have said it better myself. Kane, I got to tell you, you killed it. Appreciate your time so much. And my man, Jared Tendler, listen, I love your book. I love everything you're doing. You, me, and Kane, we could have won forever. Thank you guys both so much.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.